Do you know any investment vehicle or investment strategy that provides blend of safety, growth, tax advantages, and more importantly, protected from market loss? If you say retirement account like traditional 401k, CD or bank saving, stock or equity market, or real estate, unfortunately no. None of them provide all four of those cornerstones. In this video, I'm going to share with you an investment strategy or the investment vehicle which addresses all four of those cornerstones. Hey there, welcome back. You're with me on Be a Moon, not a star. Before we look into that investment strategy, let's understand why the renowned ones like 401k, stock or equity markets, real estate, CD or bank saving fail to address those four cornerstones. Let's begin with CD or bank saving. The first cornerstone is safety. The majority of us believe that keeping our money in the bank is always safe and secure. Well, let's see that in a different aspect. Banks are backed by FDIC in the United States. As per FDIC, your money is protected up to 250k. Let's mark it as green because the bank or CD address this cornerstone. The second cornerstone is growth. The average rate of return from your CD is between 4 to 5 percentage. It's not bad. But at the same time, we also need to consider the inflation percentage. The average inflation percentage in the United States is between 2.5 to 3.5 percentage. If you do the math between the CD rate of return and the inflation percentage, the growth is going to be very thin. Let's mark this as red. The third cornerstone is tax advantages. Whatever money that you earn from your interest, maybe from your CD or bank saving, you have to pay tax for that. Let's mark it as red. And the fourth cornerstone is protected from market loss. As you invest your money in the bank, which is protected from market loss. So let's mark it as green. So overall, CD or bank saving fail to address two cornerstones. One is tax advantages and the second one is growth. Now let's look into the next investment vehicle, and that is retirement investment like traditional 401k. Retirement accounts are managed by financial service firms. In general, financial service firms are safer than banks because of the regulations that they have. Let me share with you a few. State insurance regulators enforce the financial service firms to reserve two-thirds of their money before they invest one-third of the money at risk to meet the policyholders' obligations. Number two, every year, the regulator authorities perform solvency check that will ensure that financial service firms have strong cash flow and strong equity. In order to do that, financial service firms must submit their financial statement to the state regulators every year without fail. The third one is diversified risk model. In order to maintain the wealth for the over period of time, the financial service firms diversify their investments. And lastly, financial service firms are backed by SIPC. And as per SIPC, your money is protected up to 500k. We have been hearing quite often that banks have been facing financial challenges and even declaring bankruptcy, but not the financial service firms. Let's mark it as green. And the second one is growth. Whatever you contribute to your 401k will be invested in the stock market. The average rate of return from the stock market is between 5 to 8 percentage, and of course that beats the inflation percentage as well. The good news is you may not be able to access your 401k or any retirement account until you turn into 15 and a half. That says you are giving long time to get the money grow. And that's where the compounding growth kicks off. Well, a quick note, if you access your 401k before you turn into 15 and a half, you have to pay penalty for that. Let's mark this cornerstone as green. The third cornerstone is tax advantages. When it comes to tax, there are three options out there. One is tax now, tax later, and tax never. All three options are legally approved by IRS. Well, I am planning to make a separate video to talk detail about it, but in this video, let's stick with what is needed for the retirement account like traditional 401k. The traditional 401k will follow tax later. That means when you contribute your money to your traditional 401k, you are not going to pay any tax for that. But when you withdraw the money, you have to pay tax. That is called tax later. So let's mark it as red. And the fourth cornerstone is protected from market loss. As I mentioned earlier, financial service firms use the diversified risk model. For example, 40% might be invested in the bonds, 20% might be in the index fund, another 20% might be in the small cap, and the remaining 20% might be in the large cap. That's how they diversify the investment. However, when the market goes down, you can see the negative value in your portfolio. For example, in 2020, during pandemic, the market crashed up to 25% and it was there for few months in a row. If you look back further, in 2000 and 2008, during dot-com bubble and global financial crisis, the market was down 2 years in a row. That says your money is not protected from market loss. So let's mark it as red. Overall, retirement investment like traditional 401k fail to address two cornerstones. One is tax and the second one is protected from market loss. Let's move on to the third investment vehicle, and that is stock or equity market. The first cornerstone is safety. For sure, investing your money in the stock market is not safe and secure. So let's mark it as red. And the second one is growth. If you keep your money in the stock market for the long period of time, then you may have a growth between 5 to 8%. So let's mark that as green. The third one is tax advantages. Stock or equity market is not offering any tax advantage because whatever profit that you get, you have to pay tax for that. It might be 20 or 25% of tax. And lastly, protected from market loss. As we know, whatever money that you invest in your stock or equity market is not guaranteed at all. So let's mark that as red. Overall, stock or equity market fail to address three cornerstones. One is safety, second one is there is no tax advantages and no protection from market loss. Now let's look into an investment vehicle or the investment strategy that address all four of those cornerstones. And that is IUL, Index Universal Life Insurance. IUL comes under life insurance, especially permanent life insurance. Well, if you take any permanent life insurance, which offers two components, one is death benefit and other one is living benefit, also known as cash value. The first cornerstone is safety. Life insurance is also managed by financial service firms. So whatever I mentioned during the retirement account like traditional 401k, the same applies here as well. So let's mark this as green. And the second one is growth. Whatever money that you have in your cash value account will be invested in the stock market index funds like NASDAQ or S&P 500. So the average rate of return from the index fund is between 5 to 8%. So let's mark that as green. And the third one is tax advantages. As I mentioned earlier, there are three buckets out there. One is tax now, tax later, and tax never. IUL comes under tax now, which means after tax, whatever money that you have, you're going to contribute that to your IUL. Especially the money that grows in your IUL, you're not going to pay any tax for that. At the same time, when you withdraw your money from cash value account, you're not going to pay any tax for that. So that is called tax never. This has been legally approved by IRS. And the fourth cornerstone is protected from market loss. Whatever money that you have in your cash value account will be invested in the stock market index fund like Nasdaq or S&P 500. However, your money is not invested directly in the index fund. Instead, they use indexing strategy, which means when the market goes up, you make profit. And when market goes down, you lock the gains. IUL typically offers cap and floor. Your cap might be 12 or 13 percentage, depends on the index fund that you choose. And the floor is 0 percentage. For example, if the market is down for 15 percentage, you're not going to lose anything because your floor is 0 and you lock the gains. The other side, when the market is 20% up, which means when the market overperforms, you are not going to get 20% of the profit. Rather, you will get only 12 or 13%, whatever the cap that has been mentioned in your policy. So that's how you will get the downside protection. Overall, if you look into the IUL, Index Universal Life Insurance, that addresses all four of these cornerstones: safety, growth, tax advantages, and more importantly, protected from market loss. In the next video, I'm going to talk about how IUL indexing strategy works behind the screen. Stay tuned for that. If you find this video added any value to you, please click the like button and subscribe to my channel Be a Moon, Not a Star. We'll see you there in another video a week from now. Until then, I am Prakash.